everybody. Welcome to Friday, another Talk Money with Tom show today. I want to thank everybody for joining us. We are trying on this particular show and this channel to help people have a more successful financial retirement. We do that by really answering questions, so feel free to send them in. You know, we talk about how to manage assets, you know, what to do for retirement planning, tax planning, those kind of things. So if you have questions in those areas, you can send them to asktom@talkmoneywithtom.com. You see here on the screen. You can do that actually anytime during the week also if you'd like. And then, of course, you can put something in the chat box if you see a question you want to ask, and we'll try to respond to that live here too. And then, of course, we cover a lot of questions that come up in the strategy sessions from our clients that we think everybody maybe could benefit from hearing about. So that's the basics of the show. But the basic concept that we really work on here very closely is education in those three main areas. And we believe that the more that you know about those areas, the more you have a better chance of having a successful retirement. And so one of the things you might want to do is to take a look at our channel. We have over 1,000 videos on here now, and you can go in and take a look at those at your leisure. You can subscribe to the channel, hit the little bell button. You'll get notified when we put new content on there, and just try to up your education as you're either heading into retirement or even if you're already in retirement. These are things that can help you hopefully have a more successful retirement. And then, of course, we like to answer people's questions on a one-on-one basis also. So if you have some questions you want to ask, Ethan and I, you can go to our website. There's a book an appointment button up in the corner, and basically just push that. Our schedule's on there, and you can pick a 30-minute time to meet with Ethan and I, and we'll, essentially look at, your situation and try to help you out as much as possible. So hopefully everybody can get something good about what we're going to do today. Pick some question that really works. Try to work on it within your scenario and those types of things. So I want to thank everybody again for coming very much. Now, as usual, I do like to start off the show with a summary of kind of what I saw happening in the market this week. What a week. Really incredible. First of all, this is the year-to-date chart for the S&P 500. Got that red line there kind of showing, the peaks trend is definitely down. Got the blue lines, the 200-day moving average and such too. So, our overall major trend is on a downward slide here. And we really had a poor September that just ended, on our last show. But this particular week had some very spectacular things happening. Number one, the first 2 days of the week, the S&P 500 went up 5.7%. Which is violently up. I mean, that's really strong. It's actually the fastest start to a quarter since 1938. So really amazing. And one of the reasons you get that is because there is just a little bit of good news. Like at that time, we were talking about, England, was trying to raise their lower taxes on their upper bracket without funding it, and they were having some problems with their bond market, and they backed off of that. So that was good news. Market kind of responded to that. And then the job openings reports came out. It was at 11.2 million. It dropped down to 10.1 million, which again, we want lots of job openings, but there's so many openings versus the number of people that are unemployed. It's creating inflation, a wage inflation. So that when that comes down, that's a good sign. And what the market's looking for is a pivot by the Fed where they stop raising rates or even raise them less than expected or even change their rhetoric would be a good start. And so, boom, you start to get some motion. Once you get some motion upward, you have a lot of short covering that happens. Like that, the Monday, Tuesday, market was up around 3%. But the most shorted stocks that day were up 6.5%. So it just shows you big powers. These people, they short a stock. They basically, borrow it from a brokerage firm, essentially. They sell it in the open market. They hope it goes down. They could buy it back at a lower price. But if it starts to go up, they have an unlimited risk, so they buy it back. And, of course, as they're buying it back, that just means that it has a chance to even go up higher.
Snowballs it.
Yeah, right. And so that's kind of what happened Monday, Tuesday. But we're not holding that. And so, you'd like to see that go, right? And we got those 2 days, hold up a little bit, and then keep going, get through that blue line up there, that 200-day moving average. But Wednesday, we hit 0.2% down on the S&P 500. Yesterday, Thursday, 1% down the S&P 500. And we were nearing 3% down this day today, as the show started. So we're giving it back. We're still up a little bit for the week, but not a lot. And unfortunately, it's kind of another failure. If you look back there, you can see 4 green bars that went straight up, and then it failed then too. So this has been happening a lot. These are very common in bear markets where things are coming down. You get these sharp rallies because of the short covering. And then sometimes those sharp rallies short covering turns into, hey, everybody jumps on board, and you might turn it into, a new trend. But right now, the thing that's important to understand is that the primary trend is down. And so the secondary or the minor trend is up. Now, that's not normal. In 2021, in 2020, 2019, you name it, the primary trend was up all the way through all of those, and that's what's changed this year. And so that does take a bit of a different methodology here, in my opinion. We hung in there, did some rebalancing, tried to get the portfolios to work on the upside up until we got to that 20% down, and then we switched around the portfolio to be more T-bills, more ultra short-term bonds, and now even over the last 2 weeks, we've had an inverse position that goes up when the stock market goes down. And so our models right now are actually inverse. We are trading with the trend, which is down. And so I think there's some danger here for where we're at, because we're kind of getting back down to the low that we just hit in September. We could, fall farther, and there's not a lot of support underneath that, and we could come down fairly quick if we do come down. I think that's why the market's kind of selling off today. We do have one thing that's happening next week on Wednesday. We're going to get the CPI, the inflation report. Maybe that's good, right? Maybe there's good numbers. I wouldn't be surprised. Watch, it'll run up a little before. It's happened last time. Some hope that it's better. Turned out to be worse, actually, because core inflation went up last month, or the month before last. So we're going to find out what happened in September on Wednesday. That could be a catalyst. But the problem is the Federal Reserve is really, really committed to trying to go after inflation. And we're looking at probably a 3/4 point increase here on November 2nd when they meet. And then, there's some debate about what's going to happen in December when they meet for the last time for the year. Will they go with a quarter or a half or 3/4? Market's starting to factor in a 3/4 after today's report. So today, the big catalyst has been the jobs report. Okay, so this is the non-farm payrolls month over month for the last year. So here's a couple things I think I see out of this. First of all, we had 263,000 jobs created in September. But if you look at the overall trend over the year, it's coming down. The new job creation is softening. Got a couple of blips in there, in March and in July, et cetera. But we're heading downward, which now normally we don't want to see that. We want lots of jobs. We want to see it coming up. But this is an inflationary environment. And during a high inflationary environment, creating lots of new jobs creates a lot of wage pressure, right? Where you start to see an increase in wage. And wages are up 5% year over year this September versus last September. You can't have, in my opinion, 2% inflation when you have 5% wage growth, right? So they've got to get wage growth to soften up. And there are some good numbers in here, but it wasn't even close to being as good as people thought in terms, again, bad being good now, unfortunately. And so the market's now selling off because of that as far as that goes. And so, that's a key component to watch for here as far as that goes. And then, here's the unemployment rate actually dipped back down to 3.5%. I think that was probably the biggest surprise today. It was expected to stay at 3.7, which is where it was last month. And so here's why you've got to pay attention to the jobs reports if you want to kind of understand what the Federal Reserve might do, because the Federal Reserve has a dual mandate, and they're pretty specific about this. Number one is to have what they call full employment, right? Different definitions of that. Number two is to have low inflation, target being 2% on core inflation. And that sometimes conflicts with each other, right? They raise rates, and all of a sudden you've got a higher and higher unemployment scenario. But see, when you have unemployment coming down, and when you still have 263,000 jobs that were just created for the month of September, the Federal Reserve can look at that and say, okay, that part of our mandate is good. We can go after inflation aggressively. And actually, if you think back to the history of how the Federal Reserve deals with things in the 70s, when we had this high inflationary situation, they raised rates and raised rates, and all of a sudden unemployment came up. And then they started to back down, probably from just, it's a painful scenario to have high unemployment for the country and those people that are unemployed. But it turned out to be a huge error, because when they came back down, inflation wasn't completely stamped out, and we ended up with massive inflation at the end of the 70s and the very beginning of the 80s, to the point where the inflation, CPI was at 12%, not 9% like we just hit in July. And the Federal Reserve had to raise rates to 19%. Right, we're at 3.25% right now, in order to bring that down. And of course, this is a real problem for the stock market, because it's an environment where rates are extremely high. It's difficult for people and companies to borrow and to be efficient in that type of frame. And so that's one of the things that really drove this market down, starting with the Jackson Hole speech, was Chairman Powell's commentary about how they're looking at the 70s employment, right? And so right now their projected unemployment at their peak inflation rate is 4.1%, maybe it's 4.4, one of those two. That's probably wishful thinking, honestly, because most people seem to think it'll get closer to 5 or 6 by the time they really get inflation down. So, and this is what really I think is causing the problems for the stock market, is this long-term outlook of raising rates. And of course, usually when that happens, something eventually breaks, and that causes all kinds of problems. Maybe it's a emerging markets defaults on their debt, or who knows what it is. Usually the worst ones are the ones that we don't know about right now, that we're not talking about. But generally speaking, when you raise rates and the globe raises rates like we're doing now, something breaks. I mean, that's been a normal scenario. We're all kind of looking around now, seeing what's going to happen, and that's kind of driving the market down. So. The other aspect of this is just kind of the recessionary pressure that comes on here. It looks like the gross domestic product projection is going to be decent for the quarter, actually, maybe 2.7%. We had the first quarter, second quarter were both poor, even negative, right? This one might be positive. So I don't know if we're in a recession already or not, but I think the bigger question is what's going to happen in 2023, because raise rates now affect 6 months from now. And they've been raising. So, we haven't seen the full effect for what they've done already. And so that's why you see these indicators like this. This is by ClearBridge. I've talked about this before. And I'll move myself over here so you guys can see the sources and everything here too. But this is a really cool measurement of recession risk here. It's 12 different pieces. They kind of have a green or yellow or red, depending on where it's at. But the overall signal right now as of August, has gone to recession, right? And it wasn't even in June, it was still green. So things are moving in that direction on a leading indicator basis. And then we go and we look at, the next one here, the leading economic index. So that's a blue line, right? The gray line is actually what they call a coincidence index. It just means that it's the actual economy right now. And so if you look at that blue line, here in the recent times, you can see it's peaked quite heavily, actually. It's really coming down, whereas the gray line there is still going up. So the economy, just like I said, the GDP is still growing, but the indicators that look forward are down. And if you look back, to the 2006 timeframe there, you see a peak. Eventually led to the giant, recession that we had in 2008. Stock market dropped 57% there. You look back even farther, there's another gray bar there. That was the 2000 recession. Market dropped 45% there. So, this is one of the things you got to be concerned with. Yes, the market has come down 24% from the high, but in the last two times that this thing peaked, it was down 45 and 57%. So that's somewhat concerning, as far as that goes. And then the last one is just the yield curve inversion. This is the 10-year Treasury versus the 2-year Treasury. And what this shows is just the difference. So when it gets below zero, that means the 2-year Treasury is paying more than the 10-year. And you can see, again, first bar out there on the left shows the 2000, it inverted, yeah? And then the next one, it inverted again before 2008. You can actually go all the way back to 1960 and see that this is fairly accurate. And if you look at where it is right now, just over Easton's head, it's inverted. And so, actually David Rosenthal on CNBC today said that there's never been a bear market that has bottomed out when the yield curve is inverted and the Federal Reserve is still raising interest rates. And so there's been a lot of talk that we already hit our bottom here in September, right? That low. Well, it would be the first time in history that that had happened. And there's unfortunately more likelihood that it continues down. And again, this just to reiterate, because I got some questions this week, why are you going inverse, after we had those 2 huge days up? And so, but this is why, right? So I'm trying to talk about, if you look at kind of the overall economic indicators, if you look at the technical indicators inside the market, it's definitely pointing towards some lower markets. If you look at the overall major trends still being down, you want to trade with that trend for a while until we can start to see some better proof for when, things might bottom out as far as that goes. So you can still make money here. You can still preserve capital here. There'll still be a great opportunity to get in at some point if it does go down farther. They kind of tamed inflation finally in 1981, and the 10 months in 1982, the S&P 500 went up 106%. So there's some chances here to make some money. And we just have to be a little bit patient here and maybe a little bit careful not to lose so much while we're waiting. So that's kind of what we're waiting for right now.
So what's the lag period between the Fed and, taming? Are we looking at taming inflation? Are we looking at like a 6 months lag period? Because it seems all these reports are coming out are kind of confirming things rather than, giving us kind of a informed picture of what's going to be ahead.
Well, yeah, the leading economic indicators are useful to look at because they go both ways. So when they peak out, that's usually a sign that things are going to fall. But then they also go up. If I go backwards here, they start up oftentimes, fairly early, and they're a good signal that things are starting to improve. So that's one of the things you'd be looking for as far as a bottoming process within the stock market. But there's a whole bunch. As to what we want to look for there, but right now the indicators are actually, like I just showed, the jobs are kind of coming down. The new jobs are coming down, but they're still above average. 263,000 jobs is still above average for what we were getting before the pandemic. We still have 1.7 people looking for jobs as unemployed people versus the number of jobs open. So 1.7 jobs open for every one person looking. That's a very tight job market, and so that's got to soften out as far as that goes. But the market does look forward. So it's looking forward 6 to 18 months, and so it's going to be looking for, a chance to move forward. And normally it'll happen when everything's really bad. Like the bottom in 2008 with March 9th, 2009, I remember that. There was no good news. And you really had to pay attention to the price of the market more than the news because the data was terrible. But the market works in advance, and it is one of the leading indicators. Matter of fact, it's in the LEI basket. This basket right here includes the S&P 500. So, watch the price and watch for that bottoming motion and those type of things. So anyway, that's what's going on in the market right now. Really appreciate, everybody getting a chance to hear the summary. Hopefully this answers some of the questions. Don't be nervous about what's happening, at least with our clients. We're taking care of this as well as we can, definitely watching it. And again, this is a chance for opportunity if we do this correctly. So keep that in mind. I think, a positive outlook here will be better than, a negative outlook in terms of trying to make some money out of this. All right, so that's our summary for today. I want to thank everybody. And, again, look forward to talking about this again next week. All right, what do we have for questions?
So could you explain in a little bit more detail what's needed for a bottom to form in just any market?
Yeah, well, I think, when we're looking at the bottom of these bear markets, Again and again, they keep talking about what the Federal Reserve is doing. And so, we don't see the bottom of markets when the Fed is raising rates. We see the bottom of markets when the Fed is lowering rates. This market seems to be moving really quickly based on even the rumor of that. So maybe it's just the change of rhetoric at least, or maybe even some support because we go 0.5% increase instead of 3/4. Something has to happen in that direction to start that bottoming process to get people excited about what could happen here. So that yield curve inversion, that you're looking at here where the 10-year is paying less than the 2-year, that probably needs to flatten out and get back to normal before you'll really start to see it. There's a lot of technical indicators we look for, moving average crossovers, different types of stretch indicators, and whatnot that you would look at to try to say, okay, this looks like a bottoming point where things are going to start to turn around. One of the biggest things for me when I really feel like things are over is when the price gets back through the 200-day moving average. Now that can be a little ways away from the bottom, but that's a really good confirming indicator over the long term in these bear markets when that price finally comes back through and accelerates upward through the 200-day moving average. That is a point to probably be 100% reinvested, and maybe you're nibbling on the way up as far as that goes, but that's a pretty good point. We almost did it. The summer rally we got within 1 point of breaking through the 200-day moving average on the S&P 500, and then that failed, and here we are again back down to the lows that we started at in the middle of June. So it's just a matter of kind of waiting for some of these things to play out, and everybody's picking bottoms that haven't existed. I mean, somebody bought a lot of stock in Monday and Tuesday. Matter of fact, there was a rumor, or maybe not a rumor, but a story about somebody buying a massive call options on the S&P 500 on Tuesday. And obviously that means that they're betting on the market going up. That call option could have got hit pretty hard here so far, in these last couple of days. So there's people calling the bottom when there is no bottom yet, and so generally don't get one until you start to see the Federal Reserve changing their tone, at least. And it's been just the opposite. That huge run-up that we had Monday, Tuesday, all of a sudden we had 3 Fed governor interviews yesterday, all very aggressive, all talking about, raising rates, staying high for a really long time. The Fed is wrong a lot, so a lot of people want to bet against them. They were, last September they were saying they weren't going to raise rates at all in 2022. So now they're saying they're going to keep them up for a really long time. When something breaks, they might have to respond to that, right? Just like England did. They had to respond and start purchasing bonds to support something that looked like it was about to break, mainly the pensions there in England. So, who knows what our Fed will do.
So you'd wait to invest once that crossover happens at the 200, or would you nibble and then at a certain point then invest the rest of the portfolio?
I would nibble, yeah, because we have a whole bunch of indicators that are earlier that could be wrong. That's a problem with nibbling, but that's why you nibble and not. But yeah, I would be 100% reinvested back into our normal model allocations if we cross through the 200-day moving average. I did that in 2008. I did that in 2000. Both those times it paid off. It's not the bottom if you look closely, right? But it's a pretty good, successful place to get back in. And then again, there's some nibble. I really like the longer term, RSIs. If we get some extreme stretches, go in with something, go long with something on those pieces. So, there's a whole bunch of places that we can take a look. And the problem is that there's just no, the 200-day moving average is down, the 100-day moving average is down, the 50-day moving average is down. The price is under all of those. There's no upward indication of trend so far at all. So, not at all. There's been several little pieces like Monday and Tuesday where it looked like things could have happened, but they've been failing. And unfortunately, they've been failing kind of faster and faster than they were. And so, yeah, we could be in for some downturn here. And again, we're well positioned for that. We'll see how that plays out. But, yeah. All right, what else do we have? Questions?
So what is an inverted yield curve, and why does it matter for us?
Yeah. we got this question, from the client, so we created a little visual here, and let me show you what that looks like. So the yield curve is normally, if you look at that green thing, it kind of curves this way, and what it's showing is that, the yield, or what the bond, in this case treasury bond is what we're usually talking about, what the bond pays, right? People want to call it the interest, but there's what the bond pays, and so the number of years that you go out, normally you get paid more. So you get paid more for a 30-year wait on a bond versus a 10, and you get paid more on a 10 than you do on a 2, and more on a 2 than you do on a 3-month, right? That's a normal yield curve, and that's that green thing that you see. But sometimes it gets inverted. Right now, you're getting paid more on a 2-year bond than you are on a 10-year bond. Let's think about that. So you don't have to wait for 10 years to get your return. You can get it more in a 2-year. And so that happens because people are worried about the future. And 10-year bonds tend to kind of follow what that worry is. And so that is becoming softer, which, in terms of the yield. And then we're seeing a bigger yield on the 2-year because they're expecting a higher interest rates in the short term, which seems like a good expectation. The Federal Reserve has certainly broadcast that they're going to raise rates some more before they get to their top bracket.
So does the I guess consumer buying demand kind of set these yields in a sense? So there's a less demand for the further out yields, so that's why they have to come down or they have to come down to kind of
it's a market mechanism, right? I mean, there's supply and demand, and so when you see an inverted yield curve, you are seeing concern about the future. That's how we look at it. I mean, and again, why does it matter? Because it precedes some big recessions. This is only going back, to 2000, but you can see, out to the left there, we had that, drop below the line there. The line is 0, which just means that their 10-year and the 2-year were equal. But and when it gets below, that means the 2-year is paying more. That preceded the 2000 recession. It preceded the 2008 recession. They can be kind of early. If you look close at that, it can be, quite a bit early. You have to be patient and wait for these things, as far as that goes. But where we are right now, we're actually quite inverted. Although one thing the studies show, the New York Fed did a really great study on yield inversions, and it's not the severity, it's not how much it's inverted, it's the length of time that matters. So you could have a very light inversion. Matter of fact, if you look at 2008, that's a fairly light inversion, but a pretty big recession that happened. So it's more the length of time. So like a 3-month inversion is, considered more indicative of a downturn in the economy than a 1-month deep inversion, if that makes sense. So, we're inverted since the beginning of July, so we're heading into that 3-month area as we speak. So, that's why it's important. It's why it's actually in all the different baskets of leading economic indicators. This is one piece you'll find in all of the ones that I've seen, is the inverted yield curve. And honestly, it's one of the ones, if you just wanted to follow one thing, it's not a bad thing to follow. But again, there's a fear of what's happening in the future, that there might be a recession, and so that inverts that yield curve. And then contrary to that, you also need to see that reverse to the other direction oftentimes to see the market start to recover. And that's what this David Rosenthal said today on CNBC. Never had a bear market hit a bottom point during a yield curve inversion combined with the Federal Reserve raising rates in the history of bear markets. Could happen this time. That's obviously true, but it's less likely to happen. It hasn't happened in the past. And so people are calling the bottom and buying like mad and such, at the, September, and then it fell. And then they bought this week, and then it's falling. So they're kind of trying to buck that trend, right? And hoping for a pivot from the Federal Reserve that doesn't seem to be coming quite yet. All right. So what do we have for our next question?
So I'm in my second marriage. How do I make sure my spouse is taken care of, but also my assets go to my children from my first marriage?
Yeah, this comes up a fair amount. This is a client question that we bring up here. because it does come up with, kind of recombining families, right? And so assets were already established with one family, and you had kids, and maybe your spouse also has kids, and those assets were established, and then we're going to bring these assets together, and people do that all kinds of different ways. Sometimes it's just a full commingle. Sometimes it's just one joint account that money gets put into to pay bills, that kind of stuff. And there's nothing wrong with any of the strategies. It kind of just what works for you. But then obviously, if you pass away, maybe you still want your kids to be taken care of, right? And normally that's done through the mechanisms of a trust, right? Where you would, sit down with a lawyer. And again, we're not lawyers, and we don't know everything about this, but we'll give you some of the highlights of it. You would sit down with the lawyer, describe that situation, and then they can start to craft, how to do this. And so a Q-tip is one of the trusts that could be established so that the money that you have goes into this Q-tip. Your spouse has access to incomes or those types of things out of that, and maybe some access to principal under certain conditions, right?
Yeah, so a Q-tip is a qualified terminable interest property trust. And so the idea is you have this property, and usually you set it up so all your assets go in there, and then it's all the income and is allowed to go to that spouse while they're still alive. So you can also set up some rules saying if they need, any kind of medical, maybe a certain kind of allowance so they can take a small portion of the principal, but otherwise they really don't have that much control unless it's like what they consider what you set up as a qualified expense for them. And then once they pass away, the rest of the assets would then go to whoever you want to set up as your beneficiaries. So let's say your adult children, you could have it set up to go there.
Yeah, when you say property, you mean like property, obviously, like real estate, but also stocks, bonds.
Maybe stocks, bonds,
cash, money markets.
Yeah,
right?
any kind of investable
Any
asset.
kind of investable asset. So that's something to investigate if that's something that concerns you as a Q-tip, to figure out, how that might work. Again, we're not attorneys. I'm sure there's some other strategies that are out there that might work also, but I have been involved in several of these, and almost every single one is some kind of trust involved that basically, elaborates on what needs to happen to make this scenario work out as far as that goes. So it can be, kind of a really nice thing to do, because you don't want to leave this for after you've passed away, because I have also seen that, where there's just this kind of infighting that happens, and, the family doesn't really need that. You can avoid that, at least to a large degree, just by, kind of spelling it out in some type of manner. So
Yeah, it's pretty common with the family home. So let's say you took your house into this marriage, and the other person sold their property, and they're coming and living at your owning house. So you want the house for them to live in for the rest of their life, but you don't want them to have, it become part of their estate. You want it to become part of yours and for your beneficiaries to take over. And so that's a really common way to use a Q-tip.
yeah, and I call that a life interest. So they'd have a life interest in the home, basically mean they could live in it for as long as they, are alive. And then once they pass away, your kids would get the home and the value of the home. There's some other considerations in there in terms of, maintenance on the home. Yeah. And both parties would probably want that. Your spouse who's living there doesn't want it to fall apart while they're living there. And then also your kids probably need to, preserve the value too. So sometimes that's spelled out inside of these Q-tips for money that is there available for improvements, maintenance, 'Cause, I don't know, I have a house that's in constant decay since the day I built it, and it's just the way it goes, right? We've all been there on that. There's something that needs to be fixed on a regular basis. If you don't fix it at all, boy, you could get away from you. Yeah. So having something, if possible, available to do that too would be something to look at. All right, good. So what's our next question?
So this question's been coming in a lot as we get closer and closer to the end of the year. What are quarterly tax payments?
Yeah, exactly right. Some clients haven't dealt with them. So, I mean, if you were working at, some company, they were withholding your taxes right out of that check. They send that in, essentially every month into the IRS or the state, and you never had to deal with it quarterly because your taxes were basically being paid with each paycheck as far as that goes. All of a sudden, you get into retirement. and not everything can have a withholding like you can with your paycheck. So many things can. If you take money out of your IRAs, you can designate how much you want to be withheld before you get it. But let's say that you have incomes coming in from capital gains and dividends and interest and rents and all these different types of things. The government doesn't want you to wait until the end of the year to pay that, right? And again, we're not tax people. We don't know all of the details. And there's a bunch of really interesting things to look into in terms of how much you actually have to pay to avoid penalty. But essentially what happens is, I think it's April 15th, June 15th, September 15th, and January 15th, you have to make payments both to the state and to the federal government to basically satisfy, for the most part, your taxes that are going to be owed. Again, there's some caveats to this, which we won't get into, but the taxes that are owed for your tax return for that next, tax filing season, which would be, April 15th. And they don't want that, all at once. Mainly, they want their cash flow. They want it all year long. They got to pay bills just like we do. They're already running a deficit, so they're not going to wait for a year to pay that at the end of the year. But a lot of people, it's the first time they've ever had to do quarterlies because they haven't had to prior to retirement. Some have, depends on what you've got. But that's what a quarterly tax contribution is. It's worth looking at. I would say one of the most challenging things is to figure out what it should be. I get so many clients that, 1 year we get a lot of capital gains and they end up paying a lot of quarterlies for the next year. That next year we have less capital gains. They get a big refund and it's just back and forth, based on, what's happening. So it can be a little bit challenging to figure out what the income, is for the year and what the projection is as far as that goes. So, but that's something that, we talked a lot about with the clients for different purposes. All right. What do we have for our next question?
In past broadcasts, you've mentioned that wealth is created through real estate and stock for the average person. Do I need to have exposure to real estate to be financially successful?
Okay. Yeah, actually, I think what I really think about there is what I call kind of normal people. Normal people get their wealth through stocks and or real estate. I don't think you have to have both. Doesn't hurt, that's for sure. They do tend to have some correlation, like we're seeing maybe real estate come down here with the stock market because they're raising rates and what have you. But there are other ways that people make money, entertainment, athletics, right? Very highly compensated CEOs create giant wealth, not being stock or, real estate. I don't know. What are some of the other ones that people do?
You could be like an entrepreneur.
Yeah,
so like someone who starts their own business or a doctor that starts their own practice.
Yep.
Someone who kind of takes on that risk, they can also get very
Right.
well compensated for that.
Yeah, and so I look at, and I would say a majority of our clientele fits into this kind of normal category. They can't dribble a basketball, at an NBA level or, whatever it is, can't sing like, some of these great singers that are out there. And so, they've made their money, through their efforts at work. They didn't get paid, $50 million a year as a CEO of some company, and they saved it. And what they did was that they bought stocks through all kinds of methodologies, and then some of them have their own home, and some of them even have other real estate, right? And so those are the things that we see as the most common avenues for building wealth. Now, it still takes savings. That's the key starting spot there. You can't have stocks or real estate if you spend everything you make. Yeah, it's just kind of the way it is. Maybe you can get lucky and get some stocks at a company. And I've had this, clients that kind of spend everything they make, but then they got stock options and the company went public and they're wealthy. But for the rest of us, generally speaking, it comes from savings. I don't think you have to have both. I think it is a really great idea to have your own home. It depends. There's some caveats to that, but for the most part, that's true. That's a nice real estate piece that you might make some money on. You have to sell it to capture that, and move, which a lot of people don't want to do, which is fine, but it's still there as an asset. It's pretty easy to get involved in the stock market, even with small dollar amounts. And so that's a methodology that is simple. Rental properties some of my very wealthy clients have rental properties. But I have other clients that don't want to have anything to do with it just because it's a lot of work, and that being a landlord is a basically skill set. I would say those people basically launched a small business when they started, buying up these properties and such, and it's still ongoing, right? They're still managing those, and even if they have a manager that's managing them, they're managing the manager, right, or whatever it is. And there's still some things that happen. So, but both are very, very good ways of generating wealth. And you don't have to go all in one or the other. You can spread it out between real estate and stocks, and I do think it's a great way to go. And even though it hasn't been so great this year, boy, overall it's been fantastic.
Yeah, and the nice thing about the stock market is you don't have to have a big sum of money to start.
Right.
You could start small. Younger you start, better it allows for it to compound over time. And so the real great thing is, I could go to Vanguard as a 20-year-old and just say, can I open a brokerage account? They just take my ID, some information, and I could put up $100 and start an account there.
Yeah, it's really hard to buy real estate of any substance with $100. So that is one of the big differences. Stocks, you can start with a much smaller dollar amount, and maybe you build it up in stocks and then take part of that out if you get some appreciation to buy some real estate as part of diversification. But you're right. Sometimes the best place to start is the stock market because of the dollar amount. It's just a lot easier. Real estate takes some capital, generally speaking. So I will tell an interesting story. We had a woman working here, not making tons of money. She was kind of administrative. She went on vacation to a small city in Florida. This was way back. This would have been in the late 80s. And she come back and she says, well, I'm going to quit. I'm moving to, I think it was Port Charles, Florida. And she bought 2 houses while she was there on her credit cards, actually. And they were like $12,000 a piece. So I guess there's some places, I don't think they still exist, but at that time there were some places you could, buy real estate with small dollar amounts. I'm not sure what their appreciation potential is. The grandmother of my wife sold a place in Hinton, Oklahoma for, a very small dollar amount too. So, it's possible, but generally speaking, the real estate that you probably want is going to be fairly expensive, and so starting with stocks can be an easier way as far as that goes. Okay, good. Well, that's our show today. Really appreciate everybody that was able to come. Great questions. Hopefully you found something that can help you. Send in your questions. We love answering these. That's what this whole show is about. Try to see if you can find something that will really help you. And feel free to, go ahead and subscribe to the channel. Hit the little bell button so you can get notified when we put new content on. Increase your education in retirement, whether you're heading to retirement or already in it. And hopefully that will help you become more successfully retired. Even if you're working with somebody, it still helps a lot. And then, of course, if you want to, you can ask your questions to Ethan and I directly just by setting up an appointment. You go to our website, hit the book appointment button, and pick a 30-minute time to do a phone call or a video conference with us, and we'll answer your questions directly that way. So I want to thank everybody so much for coming today. Another great show. Looking forward to seeing you again next Friday. Let's see what happens with this market between now and then. I think that'll be really interesting. So look forward to seeing you then. Thank you very much.